we're watching for undervalued stocks. We're watching for undervalued sectors at the moment. It's good to notice that currently small-sized companies, emerging markets, and developed worlds are undervalued, and historically they are below the average norm. As a result, we want to note it and position our portfolios accordingly. US stocks are still very expensive, even though they're by far cheaper. The same chart, you can see a year ago, what it's in parentheses is showing what was a year ago. So US growth stocks like Amazon, Apple, Google, they were 97% stretched out of 100% being completely stretched and overvalued. They were at 97. So they did subside down, they became less expensive, but they're still not the cheapest place in the market. Very interesting chart. I would recommend you studying it and noting, because future performance will depend how undervalued particular areas of the market are and potentially can rally faster. And I'll tell you one thing, that year to date, if you compare small size companies, emerging markets and developed, they progressed in January double the amount that S&P have done. So they are definitely coming off the lows and they're making more returns than the regular US stocks are. All right, so let's talk about big ideas, what's happening around the globe and what we expect. Definitely the global growth is subtrend, no wonder, because half of the world in recession already. A global recession in 23 is very likely. And in fact, as of November 2022, the global recession indicators were already at 50% level, means it could tip us into recession any moment. I think we since then made some positive improvements. US economy is stronger than the rest. US inflation is more controlled than the rest. So we are not the one who will tip the entire globe into recession. That would be other areas of the market. Europe is one of them, and I would say China would be the biggest player in this. Inflation declines steadily in the first quarter, and I think the inflation will continue declining simply because we have a higher unemployment numbers, not dramatic, but higher. And we see that consumption has been reduced. As a result, inflation started to subside. The cost of borrowing, the cost of materials, everything is expensive, so the consumption naturally goes down. So that's the goal. Federal Reserve wants to keep the rates at 2% level. I don't know if it's possible in the near term, but I think in the long term, they probably will be successful. Monetary conditions remain tight everywhere, means that borrowing is expensive. You can see you have a home equity line of credit rates probably skyrocketed to 7%. So borrowing is expensive. Monetary conditions are very tight, meaning it's expensive to now shift money around. US dollar overvalued and increasingly vulnerable as federal policy near its peak. This is a very interesting point to notate, that US dollar heavily related to international markets. When the US dollar is very expensive and start to trend down, which has been so far for the last couple of months, international markets outperform. Broad weakness in equity markets as earnings growth starts to decline. It's basically saying that companies are no longer will be making as much money. As a result, stock market might not grow till things has changed in reverse. And we'll talk about how long it might take. I don't want to talk about the high yield bonds. Obviously, high yield bonds is kind of a derivative of a stock. It's a half stock, half bond, and it carries the volatility of half of the volatility of the stock market. So we can say it with certainty that the high yield bonds are not attractive because they carry too much risk. But the areas of the market that are extremely attractive for those who have cash on hands are now CDs, savings accounts, and also bonds. Bonds currently trading in a very low valuations, and they're extremely attractive. And I probably will show you a chart over the end how much expected return we should have from bonds going forward. A key risk will be resurgent inflation. I would say not resurgence of inflation, but rather persistent and consistent inflation would be a problem. And if consumers stop spending money, which is very natural to us when we don't feel good about the economy, we don't want to spend. Even worse, then we don't have a job. And the Bay Area has been affected because of a lot of layoffs. So I believe that if consumers stop spending, that would be a much bigger problem because our economy is 70% consumption. Let's talk about real GDP and all these numbers. I'm not going to go into very deep, weeds of explaining why, what is GDP and how it's comprised, because there is different ways to look at it. But I'll just say real GDP forecast, which means after inflation, is very low. 2023 will be barely positive, and then there will be a strong rebound per forecasters, which is Capital Group, American Funds, 2024 and 2026. So the good news are ahead. We're still in a choppy market, in a choppy environment, but there will be an improvement. You can see on this line on the right that the green line represents the forecast and the blue line represents the reality. So actually in the, you can see that the fourth quarter, the market has gone down, and as well as the economic growth. And then we expect it gradually to increase, but it will depend on a lot of things. And this bank failure does not help us in recoveries. That's the problem. If we start to see more local banks fail, then we will probably see the recovery being much, much slower. So what will it take for the equity market to start rallying and for us not to have, where would the stock market bottom? There is few things that contribute to market bottoming. One of them is valuations. Once valuations become not very expensive, there will be a bottom of the market because people will start coming and buy. Big institutions realize this is now value and we want to put our cash reserves back to work. Another one is obviously the consumption and economic growth. So there is three components to it, even maybe more than that. But most importantly is, I think, the valuations and economic activities. Cost of borrowing is hugely important. I believe that's something for us to look at as well. So would the mortgage rates continue to rise? Probably we've seen the highest in November, but yet to be seen. Government, Federal Reserve, Powell is planning to raise interest rate on 22nd of March. Expectations is to be going up only by 0.25%, but a lot of economists say that potentially can be increased by higher. I disagree with that because on the latest news on the banking system, I think they will be very careful. They only will raise as much as they should. Now, this is chart describes how inflation has been going down over the last couple of months, and you can see that expectations have fallen quite a bit, and you can see that US finally started to make the progress toward reduction of inflation where the other countries have not. But because we depend on other countries for other goods and services, we actually are related to them. It's not just us controlling the inflation. I love this chart. This chart is basically showing that after terminal rates near 5%, we're at 4.6. I believe we're getting close to federal fund rate target rate of 4.75%. After that rate stopped going up, after the last rate hike, which this is historically, you can see all the last rate hikes, 2006, June, 2000, etc. They usually happen during recession, obviously. And then you can see that bond yield at that time, 12 months after, it's near between 4 and 10%. Fantastic return on the bonds with much less risk than the stocks. And on a 5-year average annual return, you can see it's even less. It's even more. It's between 5 and 10% annualized return. So if anybody wants to go into bonds after the last rate hike, expectations that you might see a higher number, single-digit return, and that's unheard of in the last 20 years. We were not able to make any money in bonds in the last 20 years till now. So great investment. Finally, we don't have to go into stocks to make money in bonds. We don't have to take excessive risk. Income is back in fixed income. So fixed income is basically another word for bonds. You can see that, and I highlighted in yellow, that average 5-year forward-looking return as the recent yield level. Yield means interest rate, right? So interest rate that bonds pay. So you can see that current yield for overall total bond market is about 4.9%, almost 5. Investment grade bonds that higher quality company produce, like the bonds from Intel and from AT&T and from Amazon, that would be 6.2%. And then high yield bonds, we call them junk bonds, bonds of the companies that are not well known, don't have a good balance sheet, 8%. And emerging market debt, which means outside of US, I wouldn't touch it that much, but you need to know what you're doing, but almost 10% return, as much as an average US stock market return. extremely high, extremely well positioned. I want to talk about munis, and when I think about municipalities, I always look at this map. I'm look how many days each state can run on savings alone. And you can see that California has 82 days of savings to run alone. Actually, it's behind only a few even better states that highlighted in the dark blue. So California is in good shape financially. There is not all states are like that. What it does, it tell me that the quality of municipalities across California are very high. They have reserves. The interest rates that municipal bonds currently pay is extremely attractive, and California is in good shape financially. All right, so let's look at this chart. I actually love this chart. This chart is showing you a couple of things. First of all, keep in mind it is forecast, so we cannot say 100% certainty, right? We have a couple more bank failures and things will look very different. But as of the moment, we can see that forecasted by Capital Group, American funds, they have one of the largest research group, and we rely on their numbers, that they believe that the first half of the year, even maybe 3/4 of the year, the GDP is going to be close to none, maybe even negative. But then in the fourth quarter, they anticipate if inflation starts to go down, and you can see the inflation numbers here. Then as inflation goes down to the nominal numbers, then the GDP expands. Some people will argue to say, well, we will not be able to see inflation that low. Agree, but this inflation is just doesn't take into consideration energy prices and food prices. So potentially we can go back to 3%. And if we do, that's going to be a great booster to GDP. So again, saying that if you want to kind of align these charts to when the recession will be over, well, it tells you that GDP starts to grow somewhat toward the end of this year. And that would be very good for us. Now, this is showing that average stock market return since 1978 that followed by the recession. And you can see that 1 year return depends on the areas of the market: growth stocks, value stocks, and the Russell 1000, which is small size companies, usually do very well. So in a time of recovery, so the business cycle has 4 stages, right? The peak, the decline, the trough, recovery, and the peak again. So during the recovery time, when we're coming out of recession, usually small size companies and value stocks do well. Everything that pays dividends do well. High quality companies usually do well. The ones that have strong balance sheet do well. So you can see that a potential 1 year return after the decline and recession is about 7 to 9%. Growth stocks don't do well till the cycle matures, and at that point, tech companies start to make a lot of money. 2 year return, that's an average return a year annualized, so 11%, even stronger. Now, after 3 years, you can see that in reality, you can be 30% higher after this decline. So basically, if we lost 20% money last year, it might take us up to 2 years to recover it, and then we start to make money. Important to stay invested. I've heard a lot in the last year from different sources that people want to time the market, want to get out, the trend, and they keep talking about it as a possibility to get in, get out. In reality, it's not. And simple answer is because when you see some months like January, and if you're in cash, it hurts. And people who can get out of the market and out of the harm's way and get back into the market in the right time, those are non-existent. Maybe we heard of them. Maybe those who know how to do it, they will keep it to themselves, because that's a knowledge that nobody should share, right? Because otherwise that can be arbitraged away by others. But it's very important for you to know your risk tolerance, to know if you have reserves and cash and savings, especially savings now pay good rate, and just let the market do the work. But only risk money in the market that you can live alone for a couple of years, so they can that money can be left alone for recoveries. That's the best idea of investment. Has 3 successful components by what I see. Number 1, diversification. Never bet very high on any companies, otherwise you can lose a lot of money without recourse. The second is control the cost of investing. There is a various way to do it these days. There is a lot of inexpensive ways to be in the market, in different sectors of the market. So cost of investing is extremely important. Annuities versus the regular ETFs, the difference could be 3% that you can keep in your pocket. The third thing that you can control is your tax brackets. How do you invest to minimize your taxes you pay on investments you hold? And actually the last one, which is the most important, the risk level. How much risk do I take? How risky is my portfolio? What is my risk score? Is my risk score higher or lower than the market? Am I comfortable? Am I in the right investments? So once you can control those variables, 4 variables, then investing becomes more like a systematic approach. You don't need to worry about the market or time in the market. We talked about recession, and when it's over, you can see what I spoke at the very beginning, that the teal line represents industrial production, and industrial production is still going down. But the market, which is the dark blue line, will recover usually 6 to 8 months before recession is over. Very important to notate, which means right in the middle of recession, we need to start thinking about recovery. Otherwise, by the time everything is hokey-pokey, well, it's too late. The market is too expensive again. All right. I want to point out just one thing here. You can see real gross domestic product percentages. Last year, even though there was not really truly announced real recession, we had 2 quarters of gross domestic product negative numbers. So actually, if you just take this particular indicator into consideration, we were already in recession last year. This is Vanguard economic forecast. I just wanted to share with you GDP growth, unemployment rates, headline inflation, monetary policy. Nobody knows for sure. This is what they estimate. But if the first top line is US markets and US economy, you can see that Vanguard anticipates that inflation will go down to 3%. That's very good. And the monetary policy rates will stay at 4.5 and to 5. Gross domestic products will be weak in 2023. But it looks like, from what they're saying, it's going to be positive, slightly positive. All right, we're almost getting close to the end of the presentation. I see we have a few questions, so I will address them in a minute. And let's talk about global recession as an indicator at a dangerous level. I did mention that this number is October number, so it's actually already old. I would say we're probably, after last week, a little bit higher than that globally, not US. Equity valuations, this is just expected returns on the different asset classes. One thing for me to point out is a lot of analysts believe that US markets will only produce 4 to 6, 7% return in the next 10 years, average a year, where they believe the small size companies will do 5 to 7. But take a look at global markets 7 to 9. They believe that the global markets will rally and they will do better by a couple of percentage points a year. This slide will talk about different times when recession happens and bad events happen. And you can see how long it usually takes to recover. So in general, it takes 12 months to 15 months to recover from particular crisis. You can see COVID, it took us very little to recover, all 1 month. After 3 months, we were up what we lost. So after 3 months, everything was good. However, you can see that in other instances, for instance, when Germany invaded France in 1940s, the market was still down 12 months after. Another instance was when Pentagon terrorist attack happened, 9/11, market was still down year after, and Lehman Brothers collapse. So given the speed of inflation and given how tight the monetary policy is and how quickly we tighten it, it's one of the tightest monetary policy and the fastest that we went from zero, from pretty much nothing to such a high rate. So probably one of the worst tightening cycles I've seen in my career is probably since 1980s. So I believe that's why the market is not going to be positive 12 months from the date it started. It started actually in end of February 2022. So we're now exactly 12 months out. So I think it will take a bit longer. All right. Should the bonds be a good diversifier? The answer is absolutely yes. Bonds gone down so much in price, they became extremely important. And we talked about it. Probably one of the last slides, I will show you, this is another forecast between 4 scenarios: soft landing, return to above average growth, stagflation, and hard landing. I personally don't see hard landing, also do not see return to above average growth. Hard landing would be a big war, would be another geopolitical event that might throw us into really deep recession. Otherwise, I don't see those scenarios. I give them very small outcome. Soft landing, very possible. If I wouldn't see the bank going under, I would say soft landing is my most likely scenario. Now I'm kind of dividing them between these two, 25% each. Stagflation, which means still persistent inflation and growth is slow. And central banks will start cutting rates, but the market will be choppy, basically with no direction. So stagflation is not good for us. We don't want to have inflation that's persistent. So soft landing would be the best outcome. Everybody has their own opinion, what percentage you can give it to. I would give it probably in January 50%. Now I would say maybe less than that. But the soft landing is a possibility, and the market has been very, very happy in January. And there is an old saying, market will go how the January goes. We'll see, will yet to be seen. Dividends represent a big portion of any portfolio performance. So I encourage you to look for dividend stocks, dividend paying ETFs that represents 38% return on the investment. So 1/3 of the performance of your account can heavily depend on dividends. And because we don't see appreciation in the accounts right now, the dividends play even bigger role. International outlook, a lot of fundamentals pointing out that international markets will have a big rebound. They will do better than US. I wouldn't buy into it's being by far greater, but maybe in certain years it will outperform S&P. By the way, last year, if you've seen the numbers, the stock market was down almost 19%. International markets were down 14%. So worth noting. Healthcare still will be one of the best areas in the market, I think, because of two reasons. A, aging population. B, a lot of money is thrown out at the problem. And C, healthcare usually holds and do really well during recession. Last year, healthcare, consumer staples, and energy were three best performing sectors. All right, so industrial production and renaissance in the United States, we see the manufacturing is coming back to US. It's great for our employment and great for our GDP growth. So I'm very proud that our country is getting our labor market back to us. We've seen this outlook, and this is it. This is my last slide, so thank you so much. Please do not hesitate to ask any questions. I went over this pretty quick, so I will give you ability to ask any questions meantime and see if we can get some, more clarifications and answers to you. Lisa, would you like to start the questions, or should I just read them out loud myself? All right, so let me see. Let's see. So people are talking about the library and where they're coming from, mega store. Any updates on China stocks? Any updates? China stocks, I don't follow China stocks. Small cap, absolutely, on small cap for sure. So China stock, instead of giving you an update on China stock, I will probably give you update on overall area, that particular area. So it's challenging. I think that China is trying to revive the economy. They understand that right now they're in recession. I think it's going to be a longer term problem. My opinion, and I've heard it before from others, that the population growth in China is very slow because of the one-child policy, and because of that, remember that consumption that drives the economy. So if we don't have a population growth and population age like in Japan, it's very difficult to drive the GDP and the stock market. So my outlook on Chinese stocks are short-term attractive because they will be coming out of recession, I think, on a stronger note. The stocks will rally, but on the longer term, I have concerns about that area only because of that demographic growth issues and a couple other things as well. Geopolitically, I see some issues there. I see the problem between China and Russia. There's a few things that concerns me as an investor. Small size companies I did address. I said that's a great opportunity. You need to go very slow into small cap. Small cap had a worse week last week. It became cheap. As I think for a couple of percentage points decline, and the stocks, some small size stocks will look really, really good. So let me see. I don't see any more questions.
Somebody asked Larysa if the slides will be available. I did start recording, but I was a little bit late.
No worries. I'm happy to just quickly, so yes, the slides we can make available, absolutely not a problem. For those who will be listening to our replay, I will just point out that we covered the outlook for 2023 and what we talked about at the very beginning at where we are as far as countries in recession and where we stand. So everything else was covered after we had the video turned on, recording turned on. So we just went over a bit of recession, and small size company question actually has great answer on this slide. So you can see that it's extremely undervalued, and generally it's one of the areas that goes really well in recovery. Okay. So do we have any other questions we should look at? And nobody asked about, I'm surprised to ask about the banking system and what's going on. So if there is any particular question.
I was wondering about that too. Do you have any concern? What are your concerns about it,
Right.
Larysa?
So on Monday, I read through a few articles, also listened to a few presentations from analysts. And on Monday, I did a summary for my clients for 30 minutes at 9 o'clock a.m. just to point out a few things. So first of all, I want to let you know that it doesn't look like it is 2008. It's not the banking system much better capitalized. We don't have any toxic debts on the balance sheets. We don't see any derogatory lending. Predatory lending. We see that banking system in general is healthy. Also, keep in mind, there is a difference between regional banks and large national banks. National banks have a stress test requirements. They have also a larger requirements for their deposits and for their reserves. So I don't believe that a national bank is a problem at all. This particular bank, 90% of its operation was because it was in the risky areas, venture capitalists, technology companies, and those in general are very, very, very risky. On the top of it, my understanding that was very specific to this bank, where they put a lot of money in reserves that was long-term, and they locked that money in the treasuries, and the treasuries, as you know, went down in value last year 25%, so they lost a lot of money. So when the short-term obligations starts to come, an investor wanted to pull money out, that was forced to sell those long-term reserves, and that caused them to lose money, and then became a trickle effect. So government supporting them, and my understanding that most depositors are getting their money back. So I think the response from the government was very quick and very strong. So there might be other couple of local banks having trouble like this one because of mismanagement. But I believe it's a local issue. It's not a national problem. It just doesn't feel good. Banking stocks sold off because of that, but in reality, this contagion, I think, will be contained. I believe that it will be contained on a local level, and national banks will not be affected.
There's another question. There's some more questions. Somebody's asking, will the US dollar lose 10 to 20% in the coming 2 years?
I don't see that happening. Everybody think about that we don't have any other currency to go into really. How would the US dollar be losing so much money? Obviously, US dollar went up a lot and in the last year, because every time interest rate goes up, the dollar will strengthen, but now it's reversed. Will it go down 10%? It's a very possible 20%. I'm not seeing it. And let's overlay another complexity on the top of it. Let's talk about cryptocurrencies. So if ever we see the government steps into the cryptocurrency regulations and become part of it, this whole reality will change. The way we see currencies will change. So as long as the US dollar is the world denominated currency, we do most exchanges worldwide in US dollars, I don't see dollar being ever that cheap. 10% decline is possible because it was just so expensive last year. So as I mentioned before, when the US dollar start to go down on value over time, we will see international markets outperform US. There was one question about real estate, I noticed.
Yeah, any outlook on the real estate market?
Well, I'm not a real estate professional, so I will approach it from economics standpoint rather than real estate, because in real estate, there is two things, right? One is economic conditions and ability of people to maintain mortgages and pay higher prices for housing. And the second one is supply and demand. So supply and demand is very local, and it's very dependent on the current environment. So supply and demand drives the price, right? I'll talk about the economic side of it. So in supply and demand, I have no comments because it all depends on the builders, depends how much, construction costs and all that. But I will focus more on the economic side of it. So as we spoke before, the economy has cycles. We agree that it's a between 10 to 14-year cycle. And my understanding that real estate also has its own cycle. And real estate is we call it coinciding economic indicator. Means as the GDP goes down as well as real estate, and then GDP starts to go back up, people start to have more money and real estate goes back up. So they go hand in hand. So my understanding that real estate has a fantastic run since 2010, 2011, if to be exact. And it had a fantastic 10, 12 years run. It will probably settle in fairly soon once the interest rates stop rising. So anticipation that real estate will be soft and softening till interest rates stop rising. Once interest rates stop rising, the real estate will sit and it's on its level for some time till people adjust, till people understand how much can I borrow on a 6% mortgage. Now, can I afford to pay $2.2 million for the house, so it has to be lower price? So the natural adjustment will happen. It's already happened. We've seen price declines. And I think Bay Area will suffer from it to some degrees, only because we are, well, there's a couple of things going on. First is because we see a lot of technology companies laying off people, right? So that's number one driver. The number two driver, which is extremely important, is how much people are willing to take out of the market and put it toward real estate. Market is down, they don't want to pull money from their Facebook, from their Google and pay for real estate. So that's Bay Area specific. So, and third is a lot of technology people now working from home, at least part-time. They don't need to live in Bay Area, they can live further away. So there's several drivers that drive particular areas here. We were very expensive, so we settled in on the more regular prices. And I believe that real estate will continue softening along with the economy till the economy stabilizes. So I'm looking at probably the next few months, if not till end of the year. So somebody is asking me, let me see, could you go over the recovering period for 23 again? Yes, I can go real quick, only because I want to respect others who listen to it. So if you tuned in a little bit later, then, I probably, will not be able to give you the entire, run up on it. But the recovery in 23 most likely will be toward end of the year. If you're talking about economic recovery versus stock market recovery, stock market is a leading indicator. It will recover 6 months before the economy is started to recover. So anticipation, if we don't have more banking failures, if economy is, if the interest rates will go up one more time or two more times, then most likely we'll see stock market start to recover in the third quarter, and the economy will start recovering beginning of next year. Very vague because we just don't know what will happen in between, right? I did cover tech stocks.
There's also a question before that, Larysa, about what would you recommend for a first-time investor? Somebody's son has
saved up money who wants to. He will be 18 in 5 years and want to be able to access the funds then. Well, obviously he's now 15, right? So
13.
13. I'm sorry, 13. 5 years, right? 13. So first of all, you would need to open an account under the minor A name, right? Because he cannot have his own account till he's 18, and you would be his custodian, his like not custodian, his like executor for that particular account. You will be that account will be under Uniform Minor Act, and you will be the one who will be in charge. Will use his social security number to have that account opened. The answer is it really depends. If the time horizon only 5 years, does he need all the money by then to buy a house or do something else? Then the answer is you need to be probably fairly conservative. I just pointed out one of the slides here. Let me just show you something real quick, so you can see it. That bonds make. Let me show you real quick. Bonds would be one of the best investing once the interest rates stop rising. Because you can see here, even bonds can make a very nice single-digit return without the stock risk. If your son and you feel comfortable to put some more money in the market through dollar cost average in the next 6 months, that could be also a good idea. because in 5 years, expectations that market will recover is very high, because we probably will see recovery in the next year or two. So if you put money in the market when it's slow, you have a higher chance to make money. This is the perfect opportunity. You just need to be very comfortable how you invest and where you will put the money, so neither you nor your child is disappointed. But you need to be on the same page risk-wise and need to discuss it with him and make sure he's covered. Somebody asked about the tech stocks. We covered. Tech stocks are going to be lagging during a recession, and even during recovery. Usually tech stocks do not lead the market. However, in January, the technology did really, really well, which surprised me. But once the market starts to go higher and more prominent, you will see technology company will pick up real quick. I think that's it. So let me just ask a couple more. So somebody asking recommended VTI versus XLP. I don't know what XLP is. VTI is total stock market. You never can go with the total stock market, right? It's like saying, I want to be fully diversified. I want to put all my money in 1,000 securities all at once. If you have a long time horizon, for you, chances of losing money is close to very low. So I like the VTI. I don't know XLP. It's probably another. Feels like I don't know what that symbol is. I don't have an ability to look. So, but total stock market for the long-term investors, all this works. CDs versus stocks. Boy, CDs versus stocks is a huge difference, because long-term rate on CDs on average between 3 and 4%. Right now it's anomaly. We see 5%, sometimes 6% on CDs. That rate will not stay beyond 2 years, right? Because interest rates will go down, CD rates will subside. So stock average return is 9 to 10% a year, average, right? That's the key word, average, because it could be plus 13, minus 20, plus 37, minus 10. But the average stock market return is between 9 and 10%. The CD average long-term return, if you look at 20-year CD rates, 3%. So it's 3 times less, 3.5. Today it's 5. 2 years from now, it's probably going to be 3.5 again. So CDs is the safe haven. You will never lose your principal. And all your short-term money can go into CDs now. Anything that you need to spend in the next 1 to 3 years can go into CDs. Anything beyond that probably wants to go into stocks, because stocks is a very good inflation hedge, and stocks produce 2 to 3 times higher return than CDs. Consumer staples ETFs, I like them. It's great, great ETFs. And we just need to know to use how much of it and which one. And do you see there will be a more bank collapse in the near future? Local banks will be under stress. I think some of them may even go under. I think government made it clear that they will support some of them. And I do see local banks still struggle in the next months or two. So the answer is on a local level, yes. On a national level, I'm not seeing it at this point. All right, so it's 6:50. I would be happy to answer a couple more questions. Lisa, maybe you have something, or maybe I didn't read all the questions.
I think you got them all. Larysa. I did want to let everybody know that you will give another talk next Tuesday at 7 p.m. on the Secure Act 2.0 and how that affects people's personal finances.
Right. We'll talk about Secure Act, what to look at, and there are 100 provisions that's been passed, and the new law passed in December 29th, 2022, so it's a brand new law. I give a few presentations and then study it. We will go over the major points that probably affect the most people. We'll probably go over about 20, 25 provisions that most important. And I will point out what to look for and how things changed to your advantage or disadvantage. And you will be up to speed on the Secure Act 2.0.